Federal Reserve, often referred to as the Fed, plays a crucial role in the U.S. economy. Established in 1913, its primary objective is to maintain price stability, regulate interest rates, and support economic growth. However, there have been concerns and criticisms surrounding the Fed's monetary policy, with some individuals and groups alleging that its actions are detrimental to the long-term well-being of the United States. Consider this startling statistic. The total U.S. national debt currently exceeds $30 trillion and continues to rise rapidly. This figure, coupled with the criticism of the Federal Reserve's handling of the economy, raises questions about the potential consequences of their policies. At the same time, the rise of Bitcoin, a decentralized digital currency, has captured the attention of governments and individuals worldwide. Bitcoin offers advantages such as transparency, security, and the potential for financial autonomy. As a result, governments have begun showing interest in Bitcoin and its underlying technology, blockchain. In light of this interest, some governments have launched initiatives to educate the public about Bitcoin and encourage its adoption. This has sparked a lively debate about the role of governments in the cryptocurrency market and their potential influence over its future. In this video, we will delve deeper into these topics, examining the Federal Reserve's monetary policy, the rise of Bitcoin, government involvement in Bitcoin education and adoption, and the alleged plan to destroy the U.S. economy. Join us as we explore the intriguing world of finance, economics, and digital currencies. Remember, it's essential to approach these discussions with an open mind and conduct further research to form informed opinions. Let's dive in. The Fed functions as the central bank of the United States, with key responsibilities such as regulating monetary policy, supervising and regulating banks, and maintaining the stability of the financial system. While the Federal Reserve plays a crucial role in the economy, it is not immune to criticism and concerns. One common criticism is that the Fed's monetary policy, particularly its control over interest rates and money supply, may have unintended consequences. Some argue that the Fed's actions can lead to inflation, distortions in asset prices, and economic instability. Critics also claim that the Fed's policies can favor certain industries or segments of the population, leading to wealth inequality. The potential negative impact of the Fed's policies on the economy is a subject of ongoing debate. One concern is the risk of inflation. Critics argue that the Fed's expansionary monetary policy, such as low interest rates and quantitative easing, can lead to excessive money creation and inflationary pressures. They believe that this can erode the purchasing power of the currency and negatively affect savers and fixed income earners. Another concern is the impact of the Fed's actions on asset prices. Critics suggest that the Fed's policies, particularly its bond buying programs, can artificially inflate the prices of stocks, bonds, and real estate. This may create asset bubbles and potentially lead to market distortions, making it challenging for investors to assess true market value and increasing the risk of abrupt corrections. The Federal Reserve's decisions and actions have been subject to controversy, particularly during times of financial crisis. For example, the Fed's response to the 2008 global financial crisis included implementing unconventional measures, such as quantitative easing and bailouts of financial institutions. These actions sparked debates about the appropriate role and limits of central bank intervention, with critics questioning the potential moral hazard and long-term consequences of such policies. Additionally, the Fed's recent response to the COVID-19 pandemic attracted attention and scrutiny. It swiftly implemented measures to support the economy, including slashing interest rates, implementing lending programs, and providing liquidity to financial markets. Critics raised concerns about the potential risks associated with massive monetary stimulus and the long-term implications for financial stability. The rise of Bitcoin. Bitcoin, introduced in 2009 by an anonymous person or group known as Satoshi Nakamoto, has gained significant attention and popularity in the digital age. Bitcoin is a decentralized digital currency that operates on a peer-to-peer network known as the blockchain. It allows for secure and transparent transactions without the need for intermediaries like banks or governments. Its underlying technology, blockchain, ensures the integrity and immutability of the transaction records. Bitcoin's significance lies in its potential to disrupt traditional financial systems. It offers an alternative to traditional fiat currencies, enabling individuals to have control over their own money and conduct transactions globally with relative ease. Bitcoin's decentralized nature and scarcity, with a limited supply of 21 million coins, make it attractive to those seeking financial sovereignty and protection against potential economic instability. There are several advantages associated with Bitcoin as an alternative currency. First and foremost, Bitcoin provides increased privacy and security in financial transactions. It utilizes cryptography to protect users' identities and secure their funds. Unlike traditional banking systems, where personal information is often required, Bitcoin allows for pseudonymous transactions, giving users more control over their privacy. Another advantage is the potential for lower transaction fees. Bitcoin transactions can be more cost-effective compared to traditional methods, particularly for international transfers. By eliminating intermediaries, Bitcoin reduces the need for transaction fees typically associated with banks or payment processors. Furthermore, Bitcoin's decentralized nature means that it is not subject to the control or manipulation of any central authority. This feature makes it resistant to government interference, censorship, or capital controls, potentially providing a hedge against economic instability or political turmoil. Governments and individuals have become increasingly interested in Bitcoin for various reasons. Governments are exploring Bitcoin's underlying technology, blockchain, for potential applications beyond cryptocurrency. Blockchain technology has the potential to enhance security, transparency, and efficiency in various sectors, including finance, supply chain management, and voting systems. Furthermore, governments recognize that Bitcoin and cryptocurrencies have gained popularity among their citizens. Rather than outright banning or ignoring this growing trend, some governments are seeking to understand and regulate cryptocurrencies to ensure consumer protection, prevent illicit activities, and harness the potential benefits. On an individual level, people are drawn to Bitcoin for its potential as an investment opportunity. The volatility of Bitcoin's price has attracted speculators looking to profit from its price fluctuations. Additionally, individuals in countries with unstable economies or limited access to traditional banking services see Bitcoin as a means to store value and participate in global financial systems. Analyzing the alleged plan to destroy the U.S. economy. Various theories and claims have circulated, suggesting that the Federal Reserve has an intent to destroy the U.S. economy. These theories often stem from skepticism or mistrust toward the actions and policies of central banks. Some theorists argue that the Federal Reserve deliberately implements monetary policies that devalue the currency, leading to inflation and economic instability. They claim that these actions ultimately erode the purchasing power of the US dollar and harm the economy. Other theories propose that the Federal Reserve, as a central banking institution, aims to consolidate power and control over the economy. Critics argue that by manipulating interest rates, engaging in quantitative easing, and providing bailouts to large financial institutions, the Fed favors the financial elite while burdening ordinary citizens with the consequences of economic downturns. Possible motivations behind the alleged plans to destroy the U.S. economy by the Federal Reserve are often rooted in broader conspiracy theories or ideological beliefs. Some theorists suggest that the goal is to create a global economic crisis, leading to the establishment of a new world order or a shift towards a different economic system. Others claim that a weakened U.S. economy would allow for greater centralization of power and influence by international organizations or supranational entities. Additionally, critics argue that by destabilizing the U.S. economy, certain entities or individuals could benefit financially. They claim that the financial elite and those with inside knowledge of the Federal Reserve's actions can manipulate markets and profit from economic turmoil. It is important to approach these alleged conspiracy theories with skepticism and critical thinking. Counterarguments and alternate explanations challenge the validity of such claims. For instance, proponents of the Federal Reserve's actions argue that its policies are aimed at stabilizing the economy, preventing financial crises, and promoting economic growth. They contend that the Fed's decisions are based on data, analysis, and the goal of maintaining price stability and maximum employment. Furthermore, alternate explanations suggest that economic downturns and crises are often the result of complex factors, including global economic trends, geopolitical events, financial imbalances, and technological disruptions. Blaming the entire U.S. economic state solely on the actions of the Federal Reserve oversimplifies a complex and multifaceted system. What do you think? Are the actions of the Fed justified? Tell us in the comments below.